G'day Fools, Scott Phillips here, the Motley Fool's Chief Investment Officer in Australia, and I'm here with another Motley Fool Stocks in Focus video. When I say I'm here, I really mean Kate Lee is here. G'day Kate, how are you?
Very well, how are you?
I'm exceptionally well. Kate Lee is our analyst extraordinaire, all-round, I don't know, good guy. Let's use guy in the non-gendered sense, all-round good guy. Kate, I really appreciate you bringing to us one of the Big Australian as it used to be called. Then it was kind of called the Big Anglo-Australian because it was part of Billiton. They dropped the Billiton name and spun that stuff off. And now we're back, I think, to the Big Australian. We are, of course, talking about BHP, or the Broken Hill Proprietary Company, as it was once known when it was operating a silver mine in Broken Hill in New South Wales. That was a very long time ago, and a lot of water has gone under the bridge for BHP in that period of time. Let's get to it, mate. You've bitten off a very large chunk today, so I appreciate you talking about BHP. I had a look at their annual report. Last I checked, I think it was like 400 pages, something like that. That's a lot of information, but I'm relying on you to break it down for us. Everyone, well, we think we know BHP, but let's actually just kick off, mate, by telling me exactly what is today's BHP.
BHP, I'm sure there are more experts out there than me, but it's one of the biggest mining companies in the world. It's a blue chip name on the ASX. It's a global scale mining operation, and then they do, I think the most important raw materials they sell is the iron ore. So iron ore is about 60% of sales, about 70-80% of profit as it stands now because of that boom. And then they do a little bit of copper. They also have oil and gas business, but I think the most important raw materials for them is, for now, it's iron ore. They actually has a dual listing structure. So they're listed here. BHP Limited is listed in Australia, and then they have BHP PLC, which is listed in London. So they've maintained this dual listing structure, I think, ever since they acquired Billiton back then. And then I think there are some changes coming for that structure. But they always run like a single company. They run by a unified board and management. What else? They hire 65,000 people globally, big operations here and the Americas as well.
Yeah. This is an extraordinary company, Kate. I've been investing. I've lived through the various parts of BHP, the old one, the new one, the new one, which, as you say, they're going to collapse that dual listing structure back down to Australia only, which will be interesting. They've, of course, done the deal with Woodside to get rid of those oil and gas assets. So the more things change, the more they stay the same, right? It's almost, we'll end up back at in Broken Hill potentially at some point. It is, and has been a remarkable story. As you say, 80-odd% of profits coming from iron ore mining in a time when the iron ore price, at least when we closed out the last financial year, was effectively close enough to a record high, if not an actual record high, $220, $240 US a ton, which is phenomenal. And these guys, BHP, Rio, and Fortescue, I should disclose I own some Fortescue shares. These three businesses between them have just remarkably low costs. It got so good, as you say. Scale is probably the key word when I think of BHP. Obviously, iron ore comes first, scale very quick second, because it really is that story of how we go from a business that started, as I said, as a silver mine in Broken Hill, has really changed with the winds, and one of those few resources businesses, I think it's fair to say, that has been able to do a reasonably good job of staying afloat, staying successful. When resources companies in general, but resource investing can be a graveyard for many investors, financially speaking, just because of the challenges of finding new deposits, getting out of the ground commercially, moving to a new one and not screwing anything up. BHP's kind of conglomerate structure, the fact that it's got deposits all around the world, as you rightly say, makes it a remarkable business. It is still one of the very biggest businesses on the ASX as well. And let's go from kind of the what was, the what is. Let's look forward. Let's look forward from an investing perspective. Let's put the investment lens over the Big Australian. Let's talk about first the investment pros. If you're going to say, well, I get what BHP does, I get kind of what it used to do, what it does now, what it might be doing in future. But let's talk to the investment itself as a capital allocator, as you are. How would you be thinking about the pros, the positives, the bull case of investing in BHP?
Yeah, actually, I used to own the shares of BHP from 2016, and I sold out last year. So I sold out a bit early. Right. But what I like about this company is, as you mentioned, right? It's very well run company, and it's one of the lowest cash cost provider for the mining operation. So I put some numbers here.
Yeah.
So BHP and Rio Tinto, their estimated cost to mine and deliver iron ore, say to China, one of the most important markets for them, is about $35 per metric ton. So that's the lowest point. So you could see, as you know, like in the mining business, we can't control, the selling prices, the commodity prices. They do what they do. They go up, they go down. So you can't control. But what you can control is that, your operating cost, cash cost to produce, mine these raw materials. And on that sense, there's not many companies. Actually, only maybe Rio Tinto could maybe on par with BHP, but they're the lowest producers. And it helps them on the downturn, right? So its EBITDA margin, obviously now EBITDA margin is very high because of that high-flying iron ore prices. But even at the downturn, say, back in 2016, it maintained a solid 38% EBITDA margin. So that obviously helps them when they go through the trough, which inevitably come. And of course, in terms of absolute EBITDA, like profit dollar amount, it will have to come down if the downturn comes. But I'm just saying that in terms of margins, they get to maintain that. And then the second point I like about this as an investment at the current point is that unification of that dual listing structure. I think because in Australia, it's just such a dominant name, and then we get franking credit as well. So I think in terms of valuations, always Australian shares are a bit at a premium to the UK shares. And then that was one of the reasons, there are these, I wouldn't call it speculators, but like investors who would seek that arbitrage opportunity always try to sell Australian part of the shares and then buy in the UK market. And that overhang is going to disappear as they as they combine these two entities into one. And I think it's just a simpler structure. So it's a removal of one of the big overhang for the company. So I think it's the right decision to do. It's a bit costly, but I think it's it has to be done at some point in time. And I think it's a good news. And then more on the demand side, you'd see as the world comes out of the COVID and the pandemic, the governments, including China, will likely proceed with social infrastructure projects or, other measures to support the post-COVID economy, economic growth. And also there's Olympic Games coming up in China. So, there's some things that we can look forward to in terms of more government measures, in terms of general economic growth, so forth and so, sort of things. And then the other point is the inflation. We always talk about inflation, it's a big thing in the market lately. And when the inflation comes, it's supposed to support commodity prices because they are real assets. And there are some, traders, hedge fund traders who like to allocate more of their assets for the commodities to hedge against the inflation. So all these things will work for BHP when it gets to the commodity prices. And then I would say valuations, right? Now, if you look at the earnings multiples, I'll touch a bit more on these multiples later on. But if you just focus on earnings-based multiples, say PER or EV/EBITDA, EV/EBITDA multiple is just 5 times right now. So it's very cheap. Dividend yields of 10%. So, all these numbers does seem to make the case stronger, along with all that potential economic growth in the near future that may actually continue to boost up the commodity prices.
Yeah, I love it, mate. It's a really, really thorough summary of lots of the reasons why you might want to look at buying shares in BHP. As you say, that cash cost, even the all-in cost, is so incredibly cheap. If you think about it, towards June, July of this year, still 2021. If you're watching this next year, last year, when the price was $240 a ton, and they were mining it for the cash costs were in the teens. And so realistically, even allowing for the all-in cost, as you say, if you're mining at $35, selling it for $200, Those are the sort of margins software companies normally talk about, and they really were fantastic times. But more importantly, as you say, even when prices fall, being the lowest cost in the industry just gives you a whole lot of protection when others are going out of business or mothballing their mines. You figure BHP are going to keep producing. It's a really good point. Let's go to the cons, mate. Let's go to the downside, the bear case, the risks. Call it what you want. If you're going to convince me not to buy shares in BHP, what argument would you make?
I think the biggest risk would be it being the price taker. It's one of the better ones, right? But then it's still a minor, which means many of my bull cases were about, how, this and that scenarios will support iron ore prices going forward. But that's all based on my guesses. Like all these macroeconomic factors, the Chinese government is going to do something, US government is going to do something. That's all my guesses. And then, it's just... so difficult to project these things correctly, consistently. And I think it's one of my favorite quotes by Peter Lynch, right? The famous investor, that if you have spent like 13 minutes per year try to predict these macroeconomic factors, then you've just wasted 10 minutes, right? So I think it's just very difficult to get these things right. So that's the biggest risk. It could go, it's an upside risk and downside risk. And then China is the largest consumer of iron ore, accounting for about half of global demand. Obviously, that's the big market. And then its property sector is a major user of steel, which iron ore is used for. So iron ore prices tend to fluctuate depending on the outlook of the Chinese economy or what the government is going to do for the property sector. So again, that comes back to my first point that it's just very difficult to forecast correctly. So the prices, like in November, iron ore prices fell sharply because there was concerns that, there's headwinds to the Chinese economic growth. There was a global energy crunch. Some of the factories had to close down and all that. And in December, the commodity prices suddenly rebounded now because the latest report from China about the imports numbers showed that a significant growth in iron ore imports, maybe also coming from the low base of the previous month as well. So it's just these things are very difficult to project. Also, in terms of cycle, right, it's a cyclical business. And in terms of cycle, we are not exactly at the trough. If anything, we are close to the upper end of the cycle, though it picked out a bit. So all these things make it a bit more difficult to project. And also, that means we've been going through a multi-year bull market, maybe like more than 1 year bull market, which means all these miners are increasing their supply and production. So that's going to all come in line. So you have to think about demand and supply as well, which will decide the price of the commodities. So actually, the matter here is not even about what's going to happen on the demand side or supply side. It is the fact it is very difficult to forecast. And then, I mentioned I invested in BHP back in 2016 because that was the trough of the cycle. So I felt like, even if I don't do like huge spreadsheet, right, about demand and supply and what's going to happen, this and that, well, I was, comfortable. I was comforted that, I'm getting in at a very low season. So, and then summer's going to come and, then it's a good business, right? Well-run business. So that was the rationale. And then there comes the valuation matrix. I mentioned earnings-based metrics, valuation metrics are very low. But that's a function of earnings being very high too. So because it's a cyclical business, earnings will go up and down, right? So when I entered in 2016, earnings-based multiples were very high. But, it didn't matter because, it's high. It's supposed to be high because it's the low cycle. If you look at, say, price-to-book ratio, which is more not directly related to the earnings, it's currently at slightly below 3 times its book, meaning we are paying 3 times of their assets valued on the book. Historically, this ratio has moved in the range of like as low as 1 time, which is very low, and then up to 4 times. except for, of course, at the peak of the cycle back in 2007 and 8, PBR was as high as 8 times. But I would say in that historical trading range, 3 times is not as high as 8 times, but it's not 1 time either. So I would say it's like maybe mid to upper range, slightly above the average. So I think it's sitting right there. So it's not less compelling, when we looked at the earnings-based multiple now. So those are the reasons that, I'd say could be the risk or could be cons of the investment case.
I love it, Kate. And you know what I particularly love is that most people, when asked about BHP or any commodity-based company, will give you really confident forecasts about where the iron ore price is going to be this time next year and what the Chinese demand is going to look like. And as you say, whether hedge fund buyers are going to buy the commodity or buy the shares. You've done the honest thing. You've done the appropriate thing. I said, you know what? The reality is the biggest con is just straight uncertainty. It is it is impossible in my view, and I think in your view, to forecast commodity price. You literally can't know what's coming next. And so by definition, any kind of certainty that anyone tries to provide about the future is best guesses. It's sales, right? You give people what they want. You give them that certainty. You know, as long as you're confident, they kind of tend to believe you. We're trying to do here the right thing, frankly, to act with a bit of integrity and say, you know what, we don't know, you don't know, and that by definition must be a risk in the investment case, because whatever forecast, I remember way back in the day, Kate, I don't think you were investing at the time, it was a very long time ago. I think it was that boom kind of around the GFC time, and it might have been a little bit after that. And ANZ was confidently predicting, I'm pretty sure it was ANZ, apologies if it wasn't, confidently predicting the iron ore price or the oil price, one of the two, was going to be at a certain price. And it didn't get anywhere near that and fell and never got back to that price. And when you make those forecasts at the time, you can't get away with it because no one comes back and says, but didn't you guys say? So often it's just a case of, as you say, being really, really clear, really honest with our members normally, or with our viewers in this case, and just saying, hey, we don't know and you don't know either. And by definition, that must be adding meaningful risk to the investment case. And I think that's a really, really honest and important thing that we're doing. And I really appreciate you doing exactly that. But now, I'm going to hold your feet to the fire, Kate. I'm going to ask you to at least look at the share price now. Imagine let's go out 5 years or so. And I'm going to ask you whether you expect BHP to be a market beater or a market lagger by the end of 2026. What's your best guess?
End of 2026, you say? Okay. For another 5 years.
5 years from now, just to pick an arbitrary time frame.
Yeah. I'll keep the suspense. I'll continue to keep the suspense and tell you my answers later on. But, that reminds me, actually, it said like 2006, 7, 8. Actually, I was an analyst actually in Korea and then covering.
There you go.
Yeah, actually back then I used to cover construction sectors, and which has a lot to do with steel prices, right? And then I remember in the Korea, I was in Korea, and then Korea is very closely linked to China in many ways. Like, all the demand, we are such a small country, and then, we attach to China, literally. And then, when the bull times comes, and then people have a tendency to extrapolate. I think it's a natural tendency. And then you see, right. The good days will continue. And prices will. And then if you set your mind on that front, you can find plenty of reasons to support your conclusion. So that's the risk that you need to watch out for. Looking back at share price performance of BHP, so I looked back, right? So over the last 5 years, it outperformed ASX massively. If you look at over the last 10 years. Over the 10 years, from the previous peak, then it has underperformed. So what I'm saying is that, again, it's very important that when you enter, in terms of cycle, then I would say actually it's going to market perform. I know it's not fun. Sorry, I should be pounding the table. I know it's a disappointment. But I say this for 3 reasons. One, as I said, I explained in the PBR trends, right? So it's right at around the average. So it's not. If you ask me before I dig on further, I thought that obviously it's at the peak of the cycle, and then I looked at the chart, and actually it had a decent pullback. Recently, also iron ore prices, people are not as crazy bullish and saying, oh, next year is going to be like another fantastic year. People have that cautious mindset, which means, it may not be at the crazy bull market. So I think we're at the mid to upper cycle. So I would say it could be, it's there, and then there are near-term catalysts as well, which could continue to support. That's one reason. And then, BHP, after the unification, its market cap is going to be 10% of ASX 200, which means it itself is a market. And then if I say about 40%, maybe 30 to 40% of the index is mining industry, then I absolutely think among that pool, BHP is ahead of the pack. And then the rest is what? Like banks, they benefit from the interest rate hike, but they are not necessarily cheap either as it stands. So I think in general, I couldn't decide. I think it could market perform. I think it could do slightly better. But again, it comes back to the point that, I think the commodity prices will continue to be slightly better in the coming year, which could be anyone's guess. So I will just go safe and then go with market perform, Scott.
There we go. I like that very much, Kate. And that, look, you know what, fools? This is what we're here for, right? We could write, really either bullish or bearish or neutral-ish commentary and put it out with, lots and lots of conviction and say, you know what, read this document and then take some action. Sometimes the right answer, as Kate's highlighting, is it's really hard to tell. And that's really, really okay. In fact, the Motley Fool, all of our services are what we call best ideas services, where we simply say, if we don't know, we leave it on the too hard pile. There is absolutely no shame. And the reason we're covering this in Stocks in Focus is because it's not a recommendation of any one of our services. And I don't think anyone at the Fool is saying BHP can't possibly beat the market. You've heard it from Kate directly. We're simply saying it's really hard to tell. And if you don't know, why would you put your hard-earned capital down on that rather than trying to find something you have a higher degree of conviction in because it has less certainty, or because the price is cheaper, or because the growth is more obviously attractive, or whatever it is, whatever combination of attributes you're looking for and you like. There are probably better ideas out there in Kate's view, and I think I agree with her when it comes to BHP, in terms of where you want to put your investment dollars. And so sometimes the answer is just, we don't know. As Kate said, if it's 10% of the market and resources are 40% of the market, and throw the banks on top, and you've got about 2/3 of the ASX. Where they go, goes the market. It's almost, by definition, hard for BHP to be meaningfully different from the index that it constitutes 10% of. Kate, you've been really generous with your time and really generous with your insights and your expertise. I really appreciate you spending some time with us. Fools, thank you for watching. We appreciate you spending time with us as well. We know there are a million other things you could be doing right now, but instead you've spent some time with us in this YouTube series, which we very much appreciate. Well, hopefully we're adding value to you, by the way, and we're not wasting your time. So Kate's expertise and insights, I hope, have made you a slightly better investor and given you a much better view on BHP as a business. All that remains is for me, on behalf of Kate, behalf of myself, and on behalf of the whole Motley Fool team, to say until next time, Fool on.